Welcome to a video covering Tesla. Wanting to do this video because there is a bloodbath going on in Tesla, down 5.5%. The market is mostly flat, but this is a cascading market. All the lows are lower, all the highs are lower. This is a falling knife now. Let's go to the weekly chart. I'm going to do high to low analysis is 65% decline. That is horrible. That is bad. This is a stock that low to high for two years did 3,000%, something like 20 to 30x. And now it's giving some back because it may have been overpriced. It may have been a pump. It may have been a bubble. If we look at price to sales, it got to 26 times sales. The low was 1 and change times sales, and right now it's 6 times sales, which is wild. I know in 2018 it did have a positive cash flow for a short time, and then it bubbled up. But what does that mean, bubbled up? So let's go back to the weekly chart. If this is a bubble, then we have a game plan for that. Every bubble basis. If Tesla was in a bubble, there's going to be a lot of trapped investors. There's a boom, there's euphoria, there's peak, there's a mania. Everybody and their mother buys the stock, everybody knows, hears about it. And then there's a collapse because people want to take their profits, they want to book their gains. Maybe the sentiment shifts, maybe they want their money back. And then when the bus gets too full, they crowd the door, they rush out the exit, and there's not enough buyers for all the sellers. That could be what's happening. Let me get rid of all the noise. And then there's going to be some value after all that. It shouldn't go to zero, as far as I can tell. So I have valuation here because this isn't just a gambling instrument. This isn't just a trading vehicle. This is a company. This is a company that makes earnings, that is full of potential dividends. So when you pay whatever the going price is, it's 141 right now, you buy the right to future dividends. The PE right now is 36. It grew sales last year at 54%. That growth rate won't continue. It won't continue growing at 39%, which is what is anticipated by analysts for next year. It won't grow. When I say it won't grow, I'm looking at a 10-year average because I need to figure out what the 10-year average of growth is for sales and earnings, but mainly sales, so I can give it a value. Benjamin Graham gives us a formula, a growth formula, because this is a growth company. We can compare the PE to the growth rate that we assign. It's a subjective growth rate. We have to pick a growth rate because we're investors. We have to figure out what we're willing to pay. If this company is going to grow at 20 to 26% year after year, that's fantastic. But we don't want to pay too much for that because that cuts into the profit margin. You want to buy it at a reasonable price, hold it, and that means you'll earn the growth. If you buy it right, you'll get 20 to 25% growth next year. The following year, you'll get it again. The following year, you get it again. And then something beautiful happens. I won't do the math, but if you use rule of 72, I can do the easy math. So let's say 25% growth means every 2.8 years, the value would double. That's what that implies. If you could get 25% in the bank, you'll almost double your money every 3 years. That's why people invest in growth stocks. but paying high PEs hurts. What was the PE over here? Let's see. The peak PE was 1,000. We'll call it 1,400. That's retarded, but it had low earnings in that year, right? It had low earnings in that year. That's why it looks very retarded. But in the future, that might be justified. But it was an early purchase. If you get stuck in these high prices and then it tanks, that's going to be stuck money. It's not going to earn a good return. But in 10 years, if this company is far more valuable, then that's the real return, right? Buying high and selling low is not the real trade. It's because we're looking for 10-year growth. When you see the growth rate at 26% and you see the PE below that, that could be good. That could be good unless these numbers change, unless we go into recession, right? So let's jump over here. I've got Tesla earnings, 141. This is what analysts expect. If you look, it's growing over time. 54%, 39, 26, 15, 16, 30, 15. So it might even be less than 20%. 20% might be an okay growth rate, not 54, not 39%. Even in 2030, maybe sales grow at 10%. And these are all just guesses. Another point that I want to make is that earnings get revised, growth rates get revised. Look at this orange line. I think that was 2022. 2019, they were expecting $1.33, and now they're around $4 for EPS. Before that, it was $2. So it fluctuates. It can fluctuate, and then your valuation might fluctuate. So keep that in mind. Just because Seeking Alpha or any research firm shows some kind of earnings stream, that's not set in stone. It's a dynamic machine, the economy. But I just want to imprint this. I want to whip out the old guide, the bubble guide, boom, euphoria, peak, and then when people start taking their profits, when the herd starts taking profits, there's a collapse. And I think we're seeing something like that. I'm hoping, because if the collapse really continues, where it goes, nobody knows, but there might be some value in there. There might be some value in there. I do know RK has Tesla in it, and it's doing the same thing. There was a bubble. It was so easy to buy ARK at the top because everybody wanted it and everybody was confident. And then we turned, and now we're here, and now we're looking for value. Momentum took us up, pessimism took us down, and now we're looking for value. Is this value? I think we're getting closer. We're getting closer, but the market is doing its thing. S&P still is not pricing recession. They're just pricing in a slower decline. The PE right now, I believe, is around 19 or 20. On average, 15 PE is normal and healthy. So we're still above average. We are not pricing in inflation. We are still pricing in some growth for 2023. 222 to 230 EPS is the growth that I'm seeing by analysts. So we are not pricing in recession yet. Imagine if we did. We wouldn't be around here, I'll tell you that. We're going to be a little bit lower if that's the case. Something like 30% is a bad recession, 30% decline in earnings. So we'll have to see. We'll have to see. Let's go back to Tesla. So yeah, if we get a decline in earnings, if people find the cars too expensive, if we're in a recession, if there's a lot of cheap used cars available, who knows? But maybe these sales aren't going to be as strong in the next 1 or 2 years. And maybe that's what the stock is telling us. Maybe that's why the price is going down. 36 PE this year, S&P is at 20. Maybe it's going to come closer to the S&P. So I don't know what's going to happen with the stock, but I want to put that in people's minds that, hey, it's possible that it goes back to its base somewhere in the 50s, 70s, maybe the 40s. It is possible. So don't jump in looking at this old price of 400 or 413 and thinking that, hey, you're going to triple your money. You might, but it might take longer than you think. That's all I'm saying. Be safe.